How's it going, guys? Today I'm going to be going over the absolute basics of day trading and pretty much everything you need to know to get started. The first thing we want to ask ourselves is, what is day trading? So the dictionary defines day trading as buying and selling a security within the same day and capitalizing off of short-term price movements. In simpler terms, this means that you're placing bets on which direction the market is going to move. You can make money by placing a long, which is betting that the price will go up, or the market going down, which is called a short. The long position, or a buy, you're essentially buying the security at a certain price and selling it at hopefully a higher price. Contrary to traditional investing, you can also make money when the price of a security goes down. This is called taking a short or selling. Shorting a security means that you're selling it at a certain price without actually owning it, and then you're buying it back at hopefully a lower price. I'll break this down super simply for you guys. Imagine you want to place a bet on the price of an apple going down. Let's say the price of the apple right now is $10. I would find someone who wants to buy an apple, and I would tell them that I'm going to sell it to them for $10. Now the next day, let's say the price of the apple goes down to $8. I could now buy the apple from a different seller for $8. That means I spent $8. And then I could sell it to the person I made my original agreement with for $10. Now that we spent $8 and collected $10, that leaves us with a profit of $2. You can do this with pretty much any financial security. So you might be wondering, what is the actual thing that I'm going to be trading? No, it's not apples. There are a shitload of different markets that you can trade, but for time purposes, I'm only going to be going over the two most popular. I'm going to start with the most popular one, which is stocks and options. So trading stocks is essentially buying and selling ownership in a company. Unfortunately, trading stocks requires a lot of capital and is generally not accessible to the average person. So most people aren't day trading stocks. And that brings us to our beautiful friend, the options market. Options contracts give you the right, but not the obligation, to buy or sell 100 shares of a stock at a certain price. There's two types of options contracts. The first one is a call, which is the right to buy 100 shares, and this is essentially betting that the price will go up. And the second one is a put, which is the right to sell, meaning you think the price will go down. And you can trade options on pretty much any big stock with options chain. Options contracts are very detailed, but all you have to know for now is that call means you're betting on the price going up and put means you're betting on the price going down. And the reason people trade options is because it gives them leverage. To put this more simply, let's say you have a call on a stock like Apple. Every time the share price of Apple goes up $1, the value of the call would hypothetically go up like $40 to $50. And the same thing vice versa. If the price of Apple goes down $1, then the price of the call will go down around $40. This all depends on the strike price, the expiration date, but I'm not going to dive too deep into that. And finally, the holy grail is the futures market. This is personally what I trade, and in my opinion, it's the best financial security to day trade. So a futures contract functions very similar to an options contract. And instead of betting on stocks, you're essentially betting on indexes and commodities like the S&P 500, gold, oil. So if you go back to the analogy I used with the apple, when I bought the apple for $8 and sold it to my friend for $10, I didn't actually purchase or sell a physical apple. What I did was I agreed to sell the apple for $10, and then I agreed with someone else to buy the apple for $8, which gave me a profit of $2. And this is exactly how a futures contract functions. Unlike the stock market, the futures market is open throughout the whole week, including nighttime. Futures are perfect for day traders because of how liquid they are and how fast they move. Another nice thing about futures is that it's very easy to control your risk. What you're looking at here is a candlestick chart. This is going to be the bread and butter of your trading. So the first thing we want to understand is candlesticks and how they function. Red candle on the left is called a bearish candle, and the green candle on the right is called a bullish candle. A bearish candle means that price went down, and a bullish candle means that price went up. The inner part of the candle is called the body, and the lines coming out of it are called the wicks. The body demonstrates the open and close price. As you can see from this bearish candle, since price went down, the price opened here and it closed down here. And the wicks show where price went during that candle. As you can see in this candle, as you can see here, the top wick shows the high price and the bottom wick shows the low price. And the wicks are identical for both bearish and bullish candles. Every candlestick on a chart displays where price went and where it closed during a certain period of time. You can change the time period of the candles by selecting a different time frame. These are the time frames that I personally like to use. This is an example of the 4-hour chart from the S&P 500. Every single candle you see here shows where price went and where it closed within the span of 4 hours per candle. I now went down to the 5-minute time frame, and as you can see, I have a much more zoomed in look of the market. Each one of these candles shows where price goes and where it closes in the span of 5 minutes. I personally like to take the majority of my trades on the 5-minute and 1-minute time frame, but I'll often use the 1-hour and 4-hour time frames to get confirmation for my trades. When we actually get to building a strategy, we're going to analyze how candlesticks moved in the past and use them to predict future behavior in the market. The final and most important concept I'm going to go over is risk management. So the three main components of risk management are limiting how much you can lose per trade, controlling how much of your total capital you risk every single day, and making sure that one bad day doesn't blow your account. So limiting how much you lose per trade means setting a stop loss. Stop loss allows you to control how much money you're comfortable losing in one single trade. Let's say I don't want to lose more than $500 in one trading day. then I would just set a $500 stop loss or two $250 stop losses. And that brings me to my next point, which is position sizing. Using a stop loss is not the only way that you're going to control your risk. Determining how big of a position you want to take is equally as important. Understand how to size your positions. You need to understand the difference between minis and micros. The majority of futures markets have two different contracts, which are minis and micros. As you can see here, one micro is 1/10 of the size of a mini. To put this in perspective with the NASDAQ, a 1-point move on NQ mini is $20, while a 1-point move on MNQ, which is a micro contract, is $2. The next concept you want to know is a risk to reward ratio, or commonly referred to as RR. Using a good risk to reward ratio will allow you to make more money when you're right and lose less when you're wrong. Personally, I like to trade a 1-to-2 RR. This means that if I had a $100 stop loss, I would have a $200 take profit. This means that you could literally only be right a third of the time and still make profit. The final part of your risk management strategy is going to be deciding on a daily drawdown limit. This is where you're essentially going to decide how much money you can lose in a single day before you stop. In my personal experience, the biggest losses come from revenge trading. Revenge trading is essentially when you're down on the day and you keep trading to make your money back. Overcoming revenge trading is going to be one of the biggest hurdles that you face in your journey. When you're trading with a statistical edge, losing days are inevitable, and learning to accept them is very important. Anyways, I hope you guys enjoyed this video, and stick around for the next one where I'm going to be introducing you to TradingView and how to get started on the platform.